Hi everyone, Joe Gentili from Saroff Gentili LLP. Today we're going to be talking about premium finance for life insurance, mostly for indexed universal life insurance, and one of the consequences when these deals don't go well. Most of the big life insurance cases that have been sold in the last few years, maybe even the last decade, have been tied to premium financing, and these are uh, intended to be for very wealthy people who have very large life insurance needs. And while they have the financial resources to cover these life insurance needs, they'd rather borrow the money from a bank to pay for the life insurance premium than use their own capital because they have higher rates of return that they could get with their own capital, or their own capital is illiquid and they don't want to liquidate it. And for a very small subset of people, premium financing can make a lot of sense for them. The commissions on premium financing cases for life insurance agents, because the cases are so big, are really, really large, probably the largest in the industry. So there's a real financial incentive to expand the pool of people that premium financing was pitched to, and that certainly did happen. There's a lot of people that were sold premium financing that either didn't need it, or they didn't really have the wealth to justify it. And the way they were sold it is they were sold essentially free insurance in a arbitrage-like situation where the insurance company, I'm just gonna make up numbers for the point of illustrating it. The life insurance policy is going to get 6% a year credited to it, and it's going to cost you 4% to borrow the money. And we're going to illustrate that out, for life. And what you're going to see is that the life insurance policy over time is going to pay and retire the loans. And at the end of the day, you're going to have free insurance or pretty close to it. And especially for people that don't really have the financial resources to cover those loans if this doesn't work out well, those deals have the potential to blow up big time. And that's exactly what's happened in the last few years. These cases continue to blow up because what we've seen is that interest rates have risen a lot, and we've seen that the illustrated crediting rates for these IUL policies are coming in a lot lower in reality than they were illustrated. So when you have your crediting rate going down and the interest rates going up, that's a problem. And one of the consequences of this, or the first consequence that people see, is they get what's called a collateral call. So when you borrow money from the bank naturally wants collateral. The primary collateral is going to be the life insurance policy itself, but there will be secondary collateral. And if the life insurance policy is the cash value of that policy is not growing as forecasted, then the bank may need additional collateral. And this is a surprise for a lot of people, and it could be a very, very damaging one because given the size of these cases and the size of the loans, collateral calls are six figures, seven-figure collateral calls sometimes. So it's tying up a lot of resources, and some people don't have the collateral to cover this. So this can be really devastating. I've seen cases where people's entire net worth was trapped into one of these arrangements. So this is this is potentially grounds for litigation because in the enthusiasm to put people into these deals because the commissions are so high, a lot of life insurance agents that sold these didn't adequately explain the risks, may have even masked the risks, didn't do their due diligence to see if this person could even afford the policy if things don't go according to plan. Life insurers were also supposed to do some due diligence to see if the insurance policy that they're getting is even appropriate for the person's life situation. So there's a lot of situations where people are put into these just awful financial arrangements if they don't work out. And there could be liability risks for the agents and the insurance companies and others that help facilitate this. And so if you're in this situation, it's really worth it to consult with a lawyer and to consult with a lawyer that's familiar with life insurance and life insurance contracts and the products and the loans, because you may have a claim. And that claim, given the size of these arrangements and just how badly they can go, that claim could be the difference between having the financial life that you planned on having and retiring with, or not. These could be really valuable and necessary claims for people to bring. So if you have any questions, if you got a collateral call and this is kind of a surprise and you're dealing with this and you're wondering what their options are, I think it makes sense to reach out to an attorney. Probably also makes sense to reach out to a fee-only life insurance advisor to see if there's anything that can be done within the policy to mitigate some of the negative effects and risks. That said, I hope you enjoyed this video, and if you're interested in this topic, I really encourage you to subscribe because we're going to be making more videos about that intersection between life insurance and law. Thanks for watching.